Here's something the financial industry doesn't want you to know. Women are better investors than men. Not slightly better, significantly better. And the data proving this has been sitting in plain sight for years, while investment firms quietly market their services to men as if they're the ones who actually know what they're doing. If you're curious about what the research actually shows, and more importantly, how you can use these insights to build real wealth, you're in exactly the right place. So if you haven't already, please subscribe to this channel. We break down the financial truths that mainstream media ignores, and new research and data lands here every single week. Let's start with the headline study that changed everything. Fidelity, one of the world's largest investment companies, analyzed millions of brokerage accounts over a 15-year period. They wanted to understand which investors generated the best returns. What they found was striking. Women's portfolios outperformed men's by nearly 1% annually. That might sound small until you understand compounding. 1% per year over 30 years doesn't just add up. It multiplies into something enormous. A difference of 1% compounds into roughly 35% more wealth by retirement. That's not theoretical, that's real money. And Fidelity isn't the only institution to find this pattern. A separate study from Vanguard, another massive investment firm, examined self-directed investor behavior across hundreds of thousands of accounts. The conclusion mirrored Fidelity's findings. Women traded less frequently, made fewer impulsive decisions, and held their positions longer. The result was consistently better risk-adjusted returns. They also looked at behavioral patterns and discovered something even more revealing. Men traded 40% more often than women. Each trade carried fees, taxes, and the risk of poor timing. Women's lower trading frequency meant lower costs and fewer mistakes. It's not flashy, it's not exciting, but it's incredibly profitable. Then there's the research from Harvard Business School. Psychologists and economists looked at overconfidence bias, one of the most expensive mistakes investors make. The finding was clear. Men exhibited significantly higher overconfidence in their investment decisions. They were more likely to believe they could time the market. They were more likely to think they had special insight into particular stocks. They were more likely to go all in on a single position because they believed in their thesis. Women, by contrast, were more conservative in their self-assessments. They questioned their instincts more often. They researched more thoroughly before committing capital. The trait that makes men feel more confident about investing is the exact same trait that makes them worse at it. Confidence is useful in many domains. In investing, it becomes a liability. The overconfident investor believes they can pick individual stocks and beat the market. Statistically, 90% of active investors don't beat the market consistently over 10 years. Yet the overconfident investor doesn't see themselves in that 90%. They see themselves as part of the elite 10%. This bias costs them constantly. They chase hot stocks. They panic sell after minor corrections. They overweight positions they feel strongly about. Women, by contrast, tend to be more aware of what they don't know. That awareness makes them more likely to diversify. It makes them more likely to stick to a plan. It makes them more likely to accept that beating the market is hard, and maybe index funds are actually the smarter choice. Here's where it gets really interesting. Multiple studies have looked at the relationship between gender and risk-taking in investing. What researchers expected to find was that women took less risk overall, and therefore achieved lower returns. That would have made intuitive sense if you believe the stereotype that women are naturally more risk-averse. But that's not what the data showed. Women took appropriate levels of risk for their time horizons and goals. They didn't take reckless risks. But they also didn't avoid risk entirely. The distinction is crucial. It's not that women are afraid of risk. It's that women are smarter about which risks to take. They're more likely to assess whether a particular risk makes sense given their circumstances. Men are more likely to take risks simply because they can, or because it feels like the right move. Another layer to this puzzle comes from behavioral finance research on anchoring bias. When investors become attached to a price they paid for a stock, they often hold on to losses hoping to break even. Men exhibit this bias significantly more than women. A woman who buys a stock at $50 and watches it fall to $30 is more likely to evaluate the stock based on its current merits and future potential. A man in the same situation is more likely to hold on, waiting for it to come back to $50. This holding on costs him years and opportunity. That capital could have been deployed somewhere more productive. But pride and the memory of the original price keep him stuck. Women suffer from this bias too, but to a measurably lesser degree. The Fidelity study actually broke down the data by marital status, and this part is almost funny if it weren't so telling. In heterosexual couples, where both partners manage their own accounts separately, women's accounts outperformed men's accounts. But in households where the woman had passed away and the surviving man took over the account, his returns immediately became worse. He started trading more. He started taking bigger risks. His returns dropped. The woman had built a system that worked. He changed everything. The lesson is simple. The traits that generate superior returns are teachable. They're not innate. But they're also not the traits that the financial industry tends to celebrate in its marketing. Investment banks and brokerage firms make money in specific ways. They profit from trading volume, they profit from asset management fees. They profit from people believing they need an expert to manage their money. This creates a perverse incentive. The industry benefits when people trade frequently, when people feel they need active management, when people feel like they need to be doing something. Marketing that celebrates decisiveness, aggression, and constant activity serves the industry's interests. It doesn't serve the investor's interests. Women's approach of buying, holding, researching carefully, and trusting a plan doesn't generate as many fees. It doesn't sell as many managed funds, but it works better for the person actually trying to build wealth. There's also interesting research on how women and men react to market downturns. During the 2008 financial crisis, market research firms tracked investor behavior. Men were significantly more likely to panic sell at the bottom of the market. They were selling when prices were lowest, locking in catastrophic losses right when they should have been holding on. Women were also scared, but they were less likely to act on that fear. They were more likely to stick with their plan. They were more likely to even continue investing through the downturn, buying assets at lower prices. This difference in emotional discipline during crises is worth a fortune over a lifetime of investing. A single panic sell during a crash can set you back 5 or 10 years. Let's talk about diversification. Research consistently shows women maintain more diversified portfolios than men. Why does this matter? Because concentration risk is one of the biggest threats to an investor's long-term wealth. A person who believes strongly in technology puts 90% of their portfolio in tech stocks. Feels smart when tech booms. They feel stupid when it crashes. A person with a properly diversified portfolio doesn't have those emotional swings. They're not distracted by the performance of any single sector because they don't have an extreme bet riding on it. Women's tendency to diversify more broadly means less volatility and more consistent long-term wealth building. It's boring, it works. One more dimension worth exploring. Studies on financial literacy have shown some interesting patterns. When women lack financial knowledge, they're more likely to seek education before investing. When men lack the same knowledge, they're more likely to wing it and learn through experience. This is the classic overconfidence bias playing out again. A woman who doesn't feel confident about her investment knowledge will read books, take courses, listen to podcasts, or talk to advisors. A man in the same situation is more likely to think he can figure it out himself. Starting from that different psychological place, the woman is more likely to make informed decisions. She's less likely to buy into hype. She's less likely to make basic mistakes. The cost of that gap in decision-making compounds over decades. Now, we need to talk about something uncomfortable. Women still invest less money overall than men do. This isn't because women are less capable. It's because women tend to have lower average incomes, more gaps in employment history due to childcare responsibilities, and less inherited wealth. These are structural inequalities, not reflections of investment ability. But this is important context. Women are actually generating better returns on smaller amounts of capital. If women had equal access to capital, equal income, and equal support, the wealth gap between genders would compress significantly. The data suggests it might actually reverse. So what's the practical takeaway? How do you use this information to become a better investor? First, understand that overconfidence is expensive. That feeling that you know what's going to happen next is probably costing you money. Before making a major investment decision, force yourself to articulate what could go wrong. Write it down. Really think about it. Second, trade less. Trading feels productive. It feels like you're doing something. But statistically, trading reduces your returns. Set a plan and stick to it. Check your portfolio quarterly or annually, not daily. Own broad index funds. Own bonds, own real estate, own international investments. Your brain wants to concentrate money where it feels smart. Your returns want the opposite. Fourth, Avoid anchoring to prices you paid. If you own an investment that's down significantly, evaluate it based on its current value and future prospects, not the price you paid. If you own an investment that's done incredibly well, evaluate it the same way. Is it still a good investment at this price? Or has it run too far? Fifth, have a written financial plan. Know your time horizon. Know your goals. Know your acceptable level of volatility. Write it down. When you get emotional during market chaos, that written plan becomes your anchor. Sixth, educate yourself. Not through hot tip blogs or stock picking podcasts, but through actual books on investing theory and behavioral finance. Understanding why you're vulnerable to certain mistakes is the first step toward avoiding them. Here's the beautiful part about this research. It doesn't mean men can't be great investors. It means that the traits most strongly correlated with investment success are traits that anyone can cultivate.